What's up, guys? It's Red Hot Trade here. Today we're going to be talking about Avis Budget Group, dollar sign car. We're going to be talking about the stock, how two hedge funds are the reason behind over 600% short squeeze in the last 2 months. And we're going to be talking about how this is actually happening, if there's any upside left, and whether you should be short right now. I just wanted to let you guys know that we are sponsored today by Breakout, a new partnership that we just have unlocked. Use code RHT to get 10% off of any of the tiers in there. You can get a $5,000 up to a $200,000 account and 10% off. Trade crypto futures on leverage and then split 90% of the profits for yourself. So it's a great firm. I stand by them 100%. And if you guys are interested in it, go use code RHT breakoutprop.com. All right, so let's get started. Look at this chart. All right, look at this chart. Non-stop green. Every day since March 26th, we've had an upside candle, and not just small upside candles, like the most insane squeeze that we've seen on any company since probably GameStop, AMC, and if you go back even further to companies like Volkswagen, who had a very similar situation going on for the technical reason why the squeeze happened, right? So this squeeze is insane. Like we went from $100 today; it closed above $700. So there's an insane rally happening right now, and I want to go over the reason for it. Every news outlet that you know has been covering this. Avis Budget looking beyond the short squeeze. What powered the rally? Some people are speculating, like Forbes here, talking about the TSA layoffs and how the lines at TSA have made it so people are opting to go on road trips rather than fly. Because companies like Hertz, another car rental company, they've gone up like 65% in the last month. But it goes way deeper than that. So if we're looking at Barron here, another company or another news outlet that's been covering this, they get down to more the technical side. One of the key points they emphasize that a short squeeze compared to GameStop, Volkswagen is driven by two investors holding 71% of shares and 107% of swaps. So Barclays' Dan Levy said that the stock is all technical, and this move is all technical and citing a sharp supply demand mismatch for the high valuation. Which, if you take a look at CAR on the technical side, you can see that the share float's around 35 million, and the short float right now is around 26%. So 26%, which you'll find out that is actually relatively low to what it was at just a couple months ago. So we're going to take a look at a really good, and we're going to dissect this. It's a great article by Doug Collins on Seeking Alpha right now that goes in depth on the reason why that this gamma squeeze is actually happening on CAR right now. So two hedge funds. These are the two main players in this, SRS and Pentwater. So both of these hedge funds have accumulated over 100% of the economic interest via shares and swaps. So 82% of CAR's float is locked up just by two institutions, right? Short interest exceeds the available float, triggering a gamma squeeze as dealers and shorts scramble to cover, further fueling the rally. So you'll be able to see that, I mean, this company has, like, the fundamentals are not great. The macro environment, even like with this mishap with TSA and them getting laid off and the increased demand, it isn't, they lost a shit ton of money last year, and there was no fundamental reason that this move should be happening. It's all on a structural basis when it comes to the float and these two main players. So we're going to be going over if, like, how it's even possible for over 100% of the company to be owned by two funds, over 100%. So when a short seller borrows a share and sells it, the buyer on the other side now also owns that same share. So the same share gets counted twice, once by the original lender who still shows it on their books, and once by the new buyer, right? So this is how the total ownership across all holders can exceed 100% of the shares at once. There's a great little graphic here that shows that. You can see up here the short lending multiplier. So the original lender, share A, moves to short seller, and now that creates the new buyer. So one share and two owners. So it's like two people owning the same car. Like they both paid for the car. The dealer sold them both the one car, but there isn't two cars. They're just one car that now these two guys have ownership over. Which you could see how that could create some issues in the long run. So total return swaps, the synthetic longs, right? Hedge fund uses a swap contract, and now the fund gains 100% of the economic upside and downside without holding the physical share. So these guys don't hold any physical shares in Avis, but their synthetics give them the upside and the downside risks with a synthetic long. So by combining the physical stock, the relent short shares, and the synthetic swaps, funds controlled more economic interest than shares that are actually issued. So because of this whole thing where one share goes to two owners and both of them putting it on their books, now technically these two investment funds own more than the shares that actually exist or that are outstanding in the company, right? So if you're unaware of what Avis actually does, they're a rental car company. They have over 684,000 rentals. They reported earnings in two segments. The Americas, which make up 76% of the revenue, around 8.9 billion, and international, which covers Asia, Pacific, etc., and that's around 24%. They were down last year. Fiscal year 25 was terrible for Avis. They were down they had a reported a net loss of $995 million. So they were not doing well. You can see that by this chart, the asset impairment and others, that it's close to $1 billion in losses for them last year. So we keep going. They'll go over why the shorts are actually getting squeezed as hard as they are. So on paper, like we were saying, the fundamentals are terrible. So the short was a good thesis, but a dying business model, drowning in debt, losing nearly $1 billion a year. The shorts were, in the right to be in their position, holding short against the company and betting against them. But where they went wrong is what's costing them billions of dollars. So Avis has 35.26 million shares outstanding, which is very small for a company this size. And a huge amount were already locked up before the squeeze even started. So this is where we get into those two hedge funds, right? SRS Investment Management held the position in Avis since 2018. So this is not a new position for SRS. They controlled about 49%. So they have a voting cap that went from 35 to 45%. They own a major percentage of the outstanding shares. So SRS lockup 49%. Then you add on the ETFs and indexes that have shares as well, and that accounts for about 10%. So only 41% of the company actually had a tradable free float. So that was only around 14 to 15 million shares. And of those 14 to 15 million shares, the short interest was on 9 million of them. So a huge percentage of the free float was short, right? So this is where Pentwater Investment Firm comes in, our management comes in. They ended up accumulating a stake in 2025 of around 12%. This was about 4.3 million shares. And between February and 20th in 2024, or February 20th and the 24th in 2025, just 2 days after the stock tanked on an $856 million quarterly loss, Pentwater bought another 425,000 shares, around $94, right? So they also, this is where things get even more interesting, they sold puts expiring March 20th at strikes of 110, 120, 125, and 130, and they bought September 18th expiry calls at $80 and $85 strikes. And because they did that, now when that expiry comes in and they're in the money, these guys are forced to buy the stock at that price, which drives up the stock even more, right? So these settled options force share delivery, while cash settled swaps force dealer delta hedging. This is a reminder of what happened to Volkswagen in 2008, or what Porsche did to Volkswagen in 2008 by owning too much of their float and then causing the stock to go up exponentially and have a squeeze. So this is a visual of what this looks like in practice. So loop one, gamma squeeze, the price rises, right? With the swaps and the calls. Then it goes to the locked float, which is 82% between SRS and Pentwater and indexes. Only 6.3 million shares were available, and 9 million of those were shorts that needed to cover. Okay, so more shares that were actually available in the float were shorts that needed to cover. Over 3 million shares that didn't even exist. Um, so price rises from the short squeeze, margin calls, borrow evaporates, lenders recall the stock, shorts forced to market buy to cover. This drives the price higher because they're buying at an exponentially higher price. So it mathematically the impossible to cover without infinite price discovery. So that's why the price is just rocketing. Like it goes from 100 to $700 in the matter of realistically like 2 to 3 weeks. So this drives the price higher. Then dealers must buy open market stock to hedge against their September $80 and $85 calls and swaps. Because remember, they sold calls for $80 and $85, which are it's deep in the money now. So they're going to have to buy back that position at $700 compared to 80 and 85. So these guys are holding on to these call positions that they sold and that are like extremely deep in the money. And then the dealer delta goes up, right? Because of this insane loop that they're in when it comes to not having enough shares, them having to buy them back, margin calls happening, and so on and so forth. This is where it gets really interesting. So why the squeeze is continuing to go, other than the technical reasons there, the short interest is still very high. Like we were just showing, it was at around 30%. But also, SRS is an insider, so that means they're subject to insider trading restrictions and can't sell until quarter one 2026 earnings release, which is around May 6th. So right now, as I'm recording this is April 21st. They have at least another 2 weeks before they can sell their positions, and they're locked in until then. Pentwater is also subject to Section 16 short swing profit rule. So this rule is basically freezing their position until roughly late September 2026. They bought shares in February and March, so any sale within 6 months would require them to return the profits to the company. The two biggest holders can't sell even if they wanted to. So that's why two companies that are holding such a massive percentage of this company's flow can't sell in profits, even though the stock is up like 700% at this point in around April 21st when I'm recording this. So, bottom line, like I said, big shout out to Doug because I'm using a lot. Doug Collins for Seeking Alpha. I'm using a lot of his article because he broke this down really well. Right now, the stock is trading on float mechanics, not fundamentals. And the float mechanics say more shares are sold short than are available to buy. So this is not a stock he would touch on either side. Me either personally. At 600 plus, CAR is neither a sensible long or a survivable short. And it really is. It's just a massive lesson on what happens when market structure is how this is. It doesn't happen often. This is a once in a blue moon thing, right? So just to finish this off, we're going to take a look at Pentwater Capital's portfolio. So right now you can see they have a big stake in Electronic Arts, CyberRock Software, Boeing, Warner Brothers, and then their next biggest, so their fifth largest holding, would be Avis Budget Group, where they have a $1.1 billion stake at an average buy price around $130.56. So they obviously, with the price sitting at $713 right now, have made a huge sum of money off this. And they're the new guys, right? They got into this late last year. They haven't been holding like SRS, or if we take a look at their investment in CAR, it's actually their number one holding behind Netflix, or ahead of Netflix, ahead of Tapestry, Nvidia, Planet Fitness, Meta, AMD, Airbnb. Avis is their number one holding, and they have an average buy price at $33.16. So they're up 1,700% right now. They haven't done anything because they can't do anything until after this earnings report comes in. So these guys own $2.2 billion in value of this company, which equals around to 17.4 million shares. So remember, this company only had 35 million shares to be distributed. So they owned about 49%, and that's not including their long position or their synthetic longs. So these guys have a massive, massive stake in this company, and they aren't able to sell just yet when it comes to taking profits because of these rules that are in place for these companies as insiders. They can't just take their profits and go. So I'm gonna wrap this up with my thoughts on Avis. I don't think that if you aren't in, don't get in. It's not worth it. I wouldn't short it until after that earnings report in May, the beginning of May. And if you're gonna be taking a trade on this, I'd be in and out quickly, and I wouldn't be on the short side for now. This is an interesting case study. Like I said, this is not a fundamental thing. This is not a long term price that's going to hold. There's just no way on fundamentals. It makes no sense. This company is actually not doing well at all, but it's a structural reason that this is happening, and it has all to do with the float and nothing to do with the company itself. So be careful if you're planning on buying this and holding it or adding it to your portfolio for the long term. This is not the one, especially not at these prices, right? Especially not at these prices. So that's pretty much all I have to say about CAR right now. An insane chart. I mean, just look at this thing. I had to talk about it. Let me know, like and subscribe to this video, and let me know, like, did you get a piece of this? Did you buy it last month? Have you gotten any of the upside? I mean, you could have bought it yesterday and made 30%. So let me know if any of you guys have benefited from this move. And hopefully we're in on the next one. I wish we were insiders that owned over 80% or over 100% of the economic interest of a company, but unfortunately we're just the little guys and we have to watch shit like this happen and just laugh because oh my god, this isn't a retail driven squeeze like GameStop or AMC back in the day. But super interesting. If you guys haven't, follow me on X, subscribe here. I'll be posting more content like this and some more trading basics videos for my day traders out there. So I appreciate you guys for watching. Until next time, I'm Red Hot Trade. Peace.